Give me choppy if it means up 60 and then down 6. I'm all for that kind of choppy. When people tell me, oh my God, the quote's off 5% or 6%, I have to say, compared to what? The market in the course of 2 years is up 100%. Give me 100 and take away 6. I
Sure.
can live with that at any point in time. I believe, for reasons that I hope we discuss later in the interview, that gold prices go over the course of a decade much higher from here, not merely higher from here. But people who hope to play that game, if that's what it is, need to understand that the market will be, first of all, volatile, but will also be, within a secular bull market, cyclical. I remember very well, Michelle, the decade of the 1970s when the gold price went from $35 an ounce to a high of $850 an ounce, a 30-fold bull market. In the middle of that amazing move, 1975, the gold price fell by half. The quote slipped from about $200, pardon me, to about $100.
Volatility and fundamental distortions that few investors understand have defined the silver market for decades. Behind every price fluctuation is a complex network of paper claims, contracts, and futures that dwarfs the physical supply. This imbalance has created a fragile system where market price often reflects speculative leverage rather than supply and demand. This makes the financial structure very vulnerable to liquidity shocks and investor behavior. Rick Rule, a respected resource investor, has consistently called out this misrepresentation. He says daily silver futures trades can approach 200 times deliverable actual silver. In such a setup, many trades never settle, just roll forward. The continual rollover hides friction between paper claims and metal availability. The threat increases when physical demand rises and inventory tightens. The effects of this imbalance are real. A 4% silver premium in London compared to Chicago allows futures holders to take physical delivery, draining supply to exploit arbitrage. Such events show system instability. Exchanges suffer when cash settlement cannot meet physical demand. In the past, they stopped trade or forced monetary settlements to protect exchange members, not market participants. These methods prevent short squeezes, but reveal an unwelcome fact. Price discovery and silver have traditionally been built for order, not transparency. However, equilibrium is tiring. The persisting disparity between physical and paper markets, retail shortages in lower denominations, and investor movement toward allocated physical storage signify the early unwinding of this imbalance. Rule believes market forces may override financial engineering as the futures market grows more pressured. For investors watching these dynamics, that turning point might redefine silver's role in the monetary system. Rick Rule clearly explains these fallacies in this interview. He discusses how the silver futures market became leveraged, what occurs when actual demand meets paper exposure, and why exchanges are unprepared for delivery mismatches. He also examines wholesale versus retail supply, manipulation, and a true market reset. Stay with us. His views show how fragile the current system is and where the biggest opportunities may be if silver decouples from gold. Please like, subscribe, and comment for more videos like this. Please enjoy the video, and thanks for supporting us.
Very liquid. There's beginning to be concern over solvency. In other words, there's a lot of cash in the system. I talk to my old clients. I'm no longer a broker, and they're really, really, really cashed up. And I think that's what's driving markets in the near term. There are concerns, however, that despite the fact that there's cash in the system, that many parts of the system are or are becoming insolvent. Liquidity and solvency are two different terms. A difference, pardon me, that people come to they come to fear in periods of time when the solvency part comes home to roost. There's a lot of liquidity in the system, and there is a trader's sense that more liquidity is coming with lower interest rates. Investors have been taught through 40 years of benign markets, that period 1982 to 2022, that the increase in cash into markets can make the markets respond. And it works, I suspect, until it doesn't. By the way, Michelle, I have no comments on valuations in the broad market. I follow natural resources and financial services
Hmm.
companies. So I can't tell you whether, as an example, consumer durables or technology are undervalued and overvalued. I don't want to talk about the S&P 500, but I do want to address the fact that some of the near-term market moves have, I think, a lot more to do with liquidity. Give me choppy if it means up 60 and then down 6. I'm all for that kind of choppy. When people tell me, "Oh my God, the quote's off 5% or 6%," I have to say, compared to what? The market in the course of 2 years is up 100%. Give me 100 and take away 6. I
Sure.
can live with that at any point in time. I believe, for reasons that I hope we discuss later in the interview, that gold prices go over the course of a decade much higher from here, not merely higher from here. But people who hope to play that game, if that's what it is, need to understand that the market will be, first of all, volatile, but will also be, within a secular bull market, cyclical. I remember very well, Michelle, the decade of the 1970s when the gold price went from $35 an ounce to a high of $850 an ounce, a 30-fold bull market. In the middle of that amazing move, 1975, the gold price fell by half. The quote slipped from about $200, pardon me, to about $100. A whole bunch of people who had been gold faithful at 200 lost the faith at 100. They got shaken out just in time to miss a move from 100 to 850. The point of all this is that, for reasons we'll discuss later, I think the gold price is going higher, but it will not be a smooth ride higher. They never are. And you made a great point. The gold price is really all about real interest rates, I think. By real interest rates, I mean the difference between the yield on the US 10-year Treasury, the world's benchmark saving instrument, and the deterioration in the purchasing power of the US dollar. I want to begin, and I think you agree with me in this, Michelle. I've listened to your work, that the CPI is not an accurate measure of the deterioration of the purchasing power of the US dollar.
Hmm.
Anybody who buys stuff can look at the price of consumer goods in the period, say 2020 to 2025, and they know that we aren't suffering from 2.5% inflation. As you point out, it was Paul Volcker allowing interest rates to go up to 18 or 19% that broke the back of the gold rally because it made other savings and investment products more attractive than gold. I don't see that in the near term. So now, after that soliloquy, let me answer your question. Polite thing to do. I believe that, very similarly to the decade of the 70s, the US dollar will, in the next 10 years, lose 75% of its absolute purchasing power. I believe we'll do that because of on balance sheet and off balance sheet deficits in the US government, relative both to gross government income, but also relative to the size of the GDP. I don't think that we have the political will to have a default in terms of off balance sheet obligations. So I think we'll have a stealth default, a default where we inflate away the net present value of the obligations. I believe further, Michelle, that the decline in the real purchasing power of the US dollar, the absolute decline in the purchasing power of the US dollar, will generate a nominal, which is to say US dollar gold quote, that mirrors the decline in purchasing power. So a 10-year long threefold increase in the gold price, or even a full fourfold increase in the gold price, is something that a reasonable statistician could imagine with a 75% decline in the purchasing power of the US dollar.
All right, let's unpack this. So, fourfold, at the very least, 16,000, if we're being modest and calling 4,000 a sort of support level. Yeah, is
If,
what you're saying.
if I was modest, I would say threefold, which is $12,000. But why quibble? Uh,
Why?
Rick's assertion that silver has a leverage ratio of 200 to 1 is not merely a statistical curiosity. It is a diagnosis of systemic risk. Market prices become abstractions that are disconnected from the underlying asset when hundreds of ounces are promised for each ounce that is available. This imbalance has endured for years due to the fact that the majority of contracts are settled in cash prior to the requirement for delivery. However, the structure begins to experience strain as regional price differentials broaden and participants demand physical metal. The rolling futures mechanism, which is intended to preserve liquidity, is beginning to reveal its vulnerability as location premiums and delivery shortages increase. This is the point at which the conversation transitions to manipulation. The rule elucidates that near-term manipulation is not a conspiracy hypothesis, but rather a consequence of market design. The price can be influenced by concentrated trading, which involves the unloading of physical silver in thin markets to drive prices down, followed by the purchase of futures at lower levels, when the futures market is many times larger than the physical supply. In a market where leverage is extreme, such strategies are feasible, albeit costly and short-term. However, manipulation is not sustainable indefinitely. The distortions that once suppressed the price of silver begin to unravel, often violently, as physical tightness increases and confidence in paper instruments erodes.
Purchasing power, I mean the US dollar versus itself, rather than the Canadian dollar, the Swiss franc, or the euros. I think that the US will hold its own against other currencies in relative purchasing power. My friend Doug Casey says the US dollar is the worst currency in the world with the sole exception of all of the others. And so, well, diversifying out of the dollar into other currencies, I don't think gives people the absolute protection or even the relative protection that maintaining savings in gold would generate. And I absolutely concur with your previous remark, which is to say, since the establishment of the Federal Reserve, the US dollar has lost 97% of its purchasing power. That means there's 3 to go, a little bit at a time. We had a dramatic downshift in the purchasing power of the US dollar in the period 1970 to 1980, a recovery, a percentage recovery, at least in the early part of the decade of the 1980s. And I think that we're headed back into a period where the downward trajectory in the real purchasing power of the US dollar gains momentum. You take an old codger like me, Michelle, somebody who's getting paid, I don't know what they give me, $4,000 a month or something in Social Security.
Wow.
They're going to give me that
I
4,000.
think you have other sources of income, thankfully, but yes, but from Social Security, yes, okay.
The point of all that is that I'll still get my $4,000 or whatever it is that they give me, but it'll buy what is today $1,000 worth of goods and services.
Hmm.
That's what'll happen, and it's not going to be a pleasant place for old codgers like me who don't have other sources of income. For me, it's a subject of amusement or something that I utilize to make a point. There are millions of Americans on fixed income who don't have the ability and haven't planned well enough to augment that income that are going to have an ugly time in the next 10 years. And that ugly time that they have, I think, will have both political and social manifestations. I'm not one who is able to comment on those. I'm only one who is able to comment on how one might diversify one's savings to minimize the bad outcomes. Balance of my lifetime, for the record, I'm a very healthy 72-year-old, and perhaps for the balance of your lifetime. What I also see simultaneously, though, is the declining hegemony of the US dollar. There will be competitors around the edges. I'm an outlier in the gold community in that I don't believe that you will ever see a gold-backed national currency.
Well, gold linked, gold backed, not
Well, those are
necessarily.
very, very, very different things. Gold denominated and gold backed are very, very different. A gold backed currency means that you can surrender it and you can receive gold for that. That
Right.
in and of its nature requires prudent governance.
Sure.
A government that spends within its means and can service its debt. Being a politician in such a circumstance is no fun whatsoever. Can you imagine, as an example, our president being constrained in his big, beautiful budget by how much gold he had in the treasury that he could distribute to U.S. savers? Could you imagine President Xi doing the same thing? People are politicians because they want to exercise power. Gold constrains the politician's power. which is the reason that the people like it. The idea that the politicians would willingly give up the thing that they strive for in life most, which is power, is inconceivable to me. Now, I do believe that individuals can and should have their own gold reserve. I personally save in gold. I maintain liquidity in US dollars. Those are very, very different words. And if you have saved in gold systematically, as I have for 25 years, and you look at the prices of goods and services in 25 years, you are struck by how cheap things are. If by contrast, for that portion of your account that you maintain in dollars, you're struck by how expensive things are. So while at the same time, I don't believe that I will in my lifetime or you in your lifetime see gold function as a real reserve currency, which is to say a direct currency, I do believe that individuals can and should structure their own life in a way where, at least with regards to their savings, they monetize their host fiat currency into gold.
This volatility is contextualized by Rick Rule's long-term perspective. He contends that the strategic investor concentrates on the fundamental trend, despite the fact that the short-term noise of manipulation may dominate headlines. Silver eventually breaks free from gold's pace in every significant precious metals bull market he has observed. The rationale is both structural and psychological. Generalist investors tend to favor the metal with a lower nominal price and a higher perceived torque when they enter late in the cycle. Historically, this is the point at which silver begins to outperform gold, frequently moving at a rate that is approximately twice that of gold. In the event that gold experiences a 300% increase during this bull market, Rule predicts that silver could experience a 600% increase. The projection in question is not speculative. Rather, it is based on historical market behavior. The convergence of monetary and industrial narratives strengthens silver's case as industrial demand for silver expands. As real interest rates remain negative, and as confidence in fiat currencies wanes, spanning from photovoltaic technologies to electronics, we are not merely observing a speculative upswing. Rather, we are observing the revaluation of a metal that is trapped between commodity and currency. Simultaneously, the integrity of precious metals pricing continues to be a global concern. The location and method of price discovery are being altered by central bank purchases, geopolitical dollarization, and the expansion of non-Western trading centers. For an extended period, Western exchanges have maintained control through paper markets. However, the equilibrium may be disrupted by a gradual transition to physical settlement in the Middle East and Asia. The distortions of the COMEX and London systems will eventually lose their influence if silver's future is increasingly centered in markets that require actual delivery. Investors are deeply affected by these implications. Although physical silver may continue to exhibit short-term volatility, its supply-demand fundamentals, its role in monetary diversification, and its growing significance in global trade all suggest that a structural repricing is imminent. The next revaluation of silver could occur promptly and decisively as the market transitions from leveraged speculation to physical validation. Moments of disruption frequently presage the most significant gains for those who are positioned early, if history is any precedent. Rick Rule's analysis serves as a reminder that the genuine sources of advantage in precious metals investing are patience, perspective, and a profound comprehension of market mechanics. I appreciate your attention. If you found this discussion to be insightful, please consider subscribing and sharing this video with other investors who prioritize substance over sensationalism. Your involvement contributes to the global metals community by facilitating the development of more in-depth analyses. I will see you in the subsequent one.